Large companies don't grow by accident. They grow by design, using a mix of financial engineering, market dominance, and strategic foresight to continuously expand their assets. Here's a breakdown of the key strategic levers they pull to keep the machine growing. 1. Organic growth. Innovating and expanding from within. Before buying new companies, giants focus on making their own core business bigger and harder to beat. R&D and product expansion. They invest heavily in research and development to create new products or improve existing ones. Think of Apple moving from the iPod to the iPhone, or Amazon evolving AWS from a simple internal infrastructure project into a cloud computing behemoth. Geographic rollout. A successful model in one country is systematically exported to others. Starbucks, for example, didn't just open cafes. They perfected a supply chain and store experience in the U.S. and then methodically replicated it across the globe, adapting slightly to local tastes. Deepening customer share, the walled garden. They don't just want a customer. They want a higher percentage of that customer's wallet. This means creating ecosystems. Once you buy an iPhone, you're more likely to buy a Mac, an iPad, and an Apple Watch. This lock-in increases the asset of each customer relationship. 2. Inorganic growth, the art of the deal. This is the fast lane to asset growth. Instead of building, they buy. Mergers and acquisitions, M&A. This is the classic move. Companies acquire competitors to eliminate threats and gain immediate market share, horizontal integration. They also buy suppliers to control costs and secure their supply chain, vertical integration. A modern example is a tech giant buying a promising AI startup. They acquire the talent, acqui-hiring, the technology, and the future revenue stream in one fell swoop. Strategic partnerships and joint ventures. Sometimes a full buyout isn't possible or desirable. Companies form alliances to access new markets or share the immense risk and cost of massive projects. For instance, pharmaceutical giants often partner to develop and market a new drug, splitting both the billions in R&D costs and the eventual profits. 3. Financial and capital allocation. Making money work harder. This is the engine room of growth. It's not just about making money, but about how smartly they use the money they have. Reinvestment and capital expenditure, CapEx. A portion of profits is constantly plowed back into the business, building new factories, upgrading technology, or opening new distribution centers. This increases their productive capacity, which is a core physical asset. M&A as an investment. As mentioned, this is a primary use of capital. They use their strong cash position or borrow cheaply to acquire assets that will generate more cash in the future. Share buybacks. This is a more subtle form of asset growth. By buying back their own shares, a company reduces the number of shares